Are you leaving hundreds, even thousands of dollars on the table with your taxes every single year? Most people don't realize a big tax refund isn't a bonus prize. It's your money you overpaid to the government. Essentially an interest-free loan you gave Uncle Sam. That's money you could have been using all year long. While some see a big refund as forced savings, you're truly missing out on using that money immediately. Whether you want to reduce your tax bill or get the largest possible chunk back, the goal is the same. Legally optimize your tax situation and maximize your financial efficiency. So how do you ensure you're not needlessly lining the government's pockets and instead keeping more of what you earn? Let's dive into the actionable steps you need to take. Here's the first step many people overlook. 1. Adjust your W-4 form annually. Stop the interest-free loan. This is the absolute core. Your W-4 form dictates how much federal income tax your employer withholds from each paycheck. If you're consistently getting a large refund, like the average $3,000 in recent years, it means you're overpaying. That's $250 a month you could have been using for debt repayment, investing, or building an emergency fund. Imagine earning interest on that money yourself, instead of letting it sit idle with the government. The fix is simple. Use the IRS tax withholding estimator tool. It's free, anonymous, and will walk you through calculating the correct withholding. Do this when you experience major life changes, like getting married, having a child, buying a house, or even getting a significant raise. Update your W-4 with HR and start seeing that money in your hands, not waiting until next April. Haver 2. Maximize deductions and credits. Don't miss out on tax breaks. This is where many people leave serious money on the table. And this next part surprised me when I first learned it. Don't blindly take the standard deduction if itemizing could get you more. Tax credits are even better than deductions because they reduce your tax bill dollar for dollar, unlike deductions which only lower your taxable income. Think about deductions for student loan interest, traditional IRA or HSA contributions, or educator expenses. For credits, families have significant benefits like the child tax credit, dependent care credit, and various education credits. The Earned Income Tax Credit, EITC, alone can be worth thousands. The key is knowing what you're eligible for. My friend Sarah always took the standard deduction. One year, she got married, bought a house, and had her first child. She was about to take the standard again, but after a quick chat, I urged her to itemize. Between mortgage interest, property taxes, charitable donations, and new child tax credit eligibility, she reduced her tax liability by almost $4,000. Her old filing habits nearly cost her. Don't let yours cost you. 3. Contribute to tax-advantaged retirement and savings accounts. This is a proactive way to reduce your taxable income for the current year, which directly impacts your tax bill or refund. Contributions to pre-tax retirement accounts like a traditional 401k or traditional IRA reduce your adjusted gross income. The lower your AGI, the less tax you're generally going to pay. Health savings accounts, HSAs, are another powerhouse. Contributions reduce taxable income up to $4,150 for self-only or $8,300 for family in 2024. Money grows tax-free, and withdrawals for qualified medical expenses are also tax-free. It's the triple tax advantage. Maxing these out isn't just smart for health or retirement. It's smart for your tax bill right now. The more you contribute, the less income the IRS sees for that year. 4. Keep meticulous records. Proof is power. You can't claim what you can't prove. Here's a tip that will save you massive headaches. Countless taxpayers miss out on legitimate deductions and credits simply because they lack documentation. This means receipts for charitable donations, medical expenses, business expenses, and mileage logs. Bank statements, investment summaries, and student loan interest statements are also critical. Digitize everything. Use your phone for receipts, cloud storage, or dedicated expense tracking apps. This isn't just for tax time. It's smart money management that will save you headaches and ensure you claim every legal reduction. 5. Review your return annually and consider professional help. Tax laws aren't static, they change. What was a deduction last year might be different this year, or new credits might have emerged. Don't rely on old habits. Take the time to review your tax situation every single year, even if you think nothing has changed. For complex situations, self-employment income, investments, real estate transactions, or major life events, consulting a qualified tax professional is often worth the cost. They stay updated on the ever-evolving tax code and can identify deductions and credits you might never find on your own. A good tax professional doesn't just fill out forms. They can offer strategic advice that saves you far more than their fee. Don't wait until April 14th to seek help. Plan ahead. 6. Understand carryovers for future tax benefits. Some tax benefits don't expire in the current tax year. For example, if your capital losses exceed your capital gains, plus an additional $3,000, you can carry over the remaining loss to future tax years. The same applies to certain charitable contributions that exceed the annual deduction limits. This is a more advanced concept, but it's crucial for long-term tax planning. Knowing these rules helps you manage financial decisions, like when to sell investments or make large donations, to optimize your tax position, not just this year, but for years to come. Again, this is an area where a tax professional can provide invaluable guidance, ensuring you maximize these benefits over time. So there you have it, 6 concrete steps to stop leaving money on the table and legally optimize your tax situation so you keep more of what you earn. The key takeaway is proactivity. Don't wait until the last minute. Understand your W-4, know your deductions and credits, leverage tax-advantaged accounts, keep excellent records, and don't be afraid to seek professional guidance. This isn't about finding loopholes. It's about claiming every benefit you're legally entitled to. Remember, this video is for educational purposes only and does not constitute financial advice. Always consult a qualified financial advisor or tax professional before making significant financial decisions. Now, for your actionable takeaway. Right after this video, go to the IRS Tax Withholding Estimator. Just search for it on irs.gov. Spend 10 to 15 minutes going through the steps and see if your current W-4 is accurate. You might find you can put more money in your pocket starting with your very next paycheck. If you found this information valuable, smash that like button, subscribe for more no-nonsense financial advice, and let me know in the comments below. What's one deduction or credit you found most useful?